on the first presentation from the intermediary. My name is Rajesh Gandhi from Deloitte. For those of you who could not attend the session yesterday, I am a tax partner with Deloitte with over 25 years of experience. Today, in fact, is my work anniversary. It's my I completed 25 years in Deloitte today on 16th of July. And I focus mostly on the financial services sector. I lead asset management tax for Deloitte, including FPIs, AIFs, NBFCs, and stuff like that. And I've also spent 3 years in the Deloitte New York office. And I was also a part of the SEBI committee, and we had drafted the new FPI regulations, which came into force 2 or 3 years back. So, and with me are my two colleagues who focus on AIFs, Vijay Morarka and Hardik Mehta, who have joined as co-hosts. And once again, welcome all of you to this first session on the role of professional services provider. So what we'll do is, we have kept our role right in the end. We'll speak on that about 3-4 minutes in the end. But mostly, we wanted to give you some thoughts around the whole AI framework from a regulatory point of view, tax point of view, and starting from scratch itself, presuming that many of you would not be aware and are toying with the idea of setting up an AIF. We'll go from the beginning and then try and also share some insights from our perspective based on our experience. And while we will cover all three AIFs, obviously the focus will be slightly more on category 3 AIFs in particular. With that, let's go to the first slide, Vijay. Yeah, this one. Here. So what's an AIF basically? AIF has been defined under the purview of the SEBI Alternate Investment Fund Regulations 2012 to mean a fund which is established in India in the form of a trust company, LLP, or body corporate for pooling private money, which means collecting money from investors, whether Indian or foreign, for investment in accordance with the investment policy laid down in the AIF documentation. And the AIF vehicle is someone which is not covered under the SEBI mutual fund regulation. So it's not a mutual fund or a collective investment scheme, which, therefore AIF can be set up or is set up with the objective of pooling money from investors. It can be set up as a trust, as a private trust, as a company, or as a partnership, which is a registered partnership or a limited liability partnership. And any other pooling vehicle, if you want to pool money from family and friends, etc., then any other pooling vehicle by this definition is not allowed. So for instance, we have many times we are asked questions, can I set up a LLP or a company just to pool money from maybe a close circle of 15-20 investors, and do I necessarily have to set up an AIF? The answer to that is yes. Either you have to register your company as an NBFC or you have to set up as an AIF, because even if you want to create a LLP structure, the registrar of partnerships does not allow an LLP because it's like a backdoor entry to what is otherwise required to be set up as an NBFC or an AIF. However, we have seen some instances where private partnerships or unlimited partnerships have been set up for pooling investor money and investing them in India, which is a vehicle which is not strictly recognized under any of the regulations. The only carve-outs, as you can see from this slide, are either a family trust, an ESOP trust for employee welfare, securitization trust, or any other vehicle which is regulated by any other regulator. Other than that, every other pooling vehicle needs to be registered as an AIF. So that's on the definition. If you move to the next slide, just let's look at a typical AIF structure and how it works. So in a typical structure, and we have taken trust here because, as I said in the beginning, generally an AIF would be set up as a trust. So we have presumed a trust structure, and with domestic investors, foreign investors, both. So if you have, let's say, typically you would have Indian investors, putting money in the AIF. You might have a few foreign investors, because today, if a NRI or a PIO or even any foreign citizen wants to invest in India, the NRI PIO can certainly do through under the PIS route, but the foreign citizen cannot invest in India unless he registers himself as a FPI or invest through a offshore vehicle like an FPI. But if you look at the AIF guidelines, there is no such restriction. So you could have domestic investors, you could have a foreign investor, foreign entity, institution, individual, or NRI who could come in the AIF in that pooling vehicle. And no specific approval is required. The only restriction is that if you have any foreign investor in the AIF, then to that extent, the AIF can invest only in those sectors which are permitted for FPIs and not otherwise. But that is only as far as the investment security is concerned. For example, short-term investments are not allowed for FPIs. And so such AIF cannot invest. But as far as the cap is concerned, there is no cap. For example, if FIIs are not allowed to invest in HDFC Bank because the limit is breached, or if they exceed the investment limit. But that restriction does not apply to an AIF, because AIF ultimately is not an FII or FPI. So you can freely take both domestic money and foreign money for your AIF investment. And if you have a significant number of foreign investors, which we are now seeing more and more of our AIF clients are looking at overseas investors, then, as I said, one is you could either directly get them, or you could set up an offshore fund. And some of our clients are now looking at creating a fund in either Singapore as a VCC, or Dubai or Ireland, and then pool foreign money from there. So once you pool foreign money, you can either put that money in the AIF, or the foreign money can be directly invested in Indian market under the FPI route. And there are pros and cons of doing that. So you can either commingle everything under one structure, or you could have two parallel structures. And there are advantages, disadvantages to doing both of that. Other than from an investor point of view, you need a sponsor. So the sponsor can be in India or abroad. And the sponsor obviously needs to bring in a sponsor commitment. The sponsor commitment can also be brought by the manager, but there are certain advantages if the sponsor and the manager are two different persons. There are certain advantages which we can talk about later on. So you would have a sponsor. You would also need a trustee if the AIF is set up as a trust, which can be a trustee within the umbrella, or it could be a third-party trustee. We have some of our cohort partners who are also trustees. So you could do that. And you would obviously need to have a manager who is based in India. The manager can be either an individual or it could be an entity, but the manager has to be based physically in India. I will take questions towards the end so that it doesn't disturb the flow. I can already see some questions coming in the chat. Now, if we move to the next slide, let's talk about what are the different parties. And I already talked about that a little bit, but let's talk about a little bit more detail on what are the parties. So if you're setting up a trust, then obviously, just like any other private trust or a public trust, you need a settler who settles the property of the trust for the benefit of the beneficiaries. It can be a small amount through which you settle and create a trust. You would need a sponsor who would be responsible for continued interest in the AIF, and sponsor commitment is being prescribed in the AIF regulations. It is different for different categories of investors. That sponsor money comes as investment in the AIF, and it obviously then earns a return. And the return which the sponsor gets, so the sponsor can be a person who is different from the manager, or it could be part of the same group. So the return which the sponsor gets can be either the same return which any other investor gets, or you could structure your variable return as a return which goes to the sponsor. So for example, if you have a carry structure, which means you give a performance fee to the manager that can be structured by way of a return on the sponsor commitment. And then obviously the investors, third-party investors or LPs who contribute to the AIF, by entering into contribution agreements and investing their capital. As I said, trustee could be an in-house trustee or it could be a third-party trustee, and the AIF would enter into a trustee agreement with the trustee for providing trusteeship services. The trustee basically is responsible in a fiduciary capacity for on behalf of the AIF, because AIF obviously is just a contract if it is set up as a trust. The trustee is responsible for having title over the property and for carrying out other compliances which are needed by the AIF, including appointment of the fund manager, removal of the fund manager, and things like that. The trustee delegates the management functions to the fund manager in terms of an investment management agreement. And the fund manager is then responsible for taking decisions on behalf of the fund and receives a fee for doing that. Let's go to the next slide. Often new clients ask us, why AI? Why, and what if I continue with a PMS? And of course, today there are a lot of successful PMSs which have not yet converted to an AIF, and at the same time, there are many PMS managers who have converted and set up an AIF, and they accept investor money in a parallel manner, which investor can come in either under the PMS route or the AIF route. But if you ask me, I would think there are more advantages than disadvantages of setting up an AIF as compared to a PMS. So, for instance, in an AIF framework, you can have multiple strategies because the AIF can invest in listed securities. It can make private investments in unlisted securities. You can have your derivative or F&O strategy there. So therefore, you can be like a hedge fund. You can do long short, and you can do complex and different kinds of strategies, which otherwise in the PMS you will not be allowed to do that because you will only invest on behalf of the investor under a PMS license in the investor's name. As far as compliance is concerned, also in an AIF, you are actually in a much better situation because once you set up the AIF, then all you need to do is to ensure your compliance at the AIF level. Whereas in the case of a PMS player, you have to undergo the onboarding process for each year, each investor, including opening his demat account, his bank account, etc. Whereas if you're an AIF, you only need to do the central KYC for this new investor. So therefore, from an onboarding perspective, every time your investor comes in, it becomes easier if you're an AIF as compared to a PMS. Investment limits, as we know, are different. You need at least 1 crore for an AIF and 50 lakhs for a PMS. So there, maybe the PMS is slightly better than the AIF, but then you can also issue partly paid units, which SEBI allows now. So you don't need to get the entire 1 crore. From a tax point of view, also, while there are advantages to both. For example, with a PMS player, you can, if you're a PMS investor, you can offset your losses in the PMS investment. What I'll do is switch off my video because there's some bandwidth issue. So in a PMS, you can offset your losses on the PMS with your other income, whereas typically if you're AIF 3, then the taxation happens at the AIF level. So the investor does not get the ability to offset losses against profits, which there I think the PMS therefore is slightly better than the AIF. But then if you look at the risk from an AIF point of view, then whether it is the P risk or risk of being resident, especially for foreign investors, if you have foreign investors, then the AIF scores over there because the AIF is managed by a fund manager in India. The other tax advantage of a PMS is that if you have foreign investors, like an NRI investor who comes under the PIS route, then he is eligible for treaty benefits, whereas if you're coming in the AIF, then as I said, normally taxation happens at the AIF level. So foreign investors don't get any treaty benefit. And then let's move to the next slide and talk about a couple of other advantages. So minimum corpus, minimum number of maximum number of investors. So PMS obviously does not have all this restriction, but for an AIF, this is sufficiently. You can have maximum 1,000 investors, which is sufficiently large for AIF, and then you can have multiple schemes. So really, these are not restrictions as such. And then I think the other point is that with the PMS, it is comparatively easy for an investor to copy strategy, because investment is made in his name and he can view his investments virtually on a daily basis. Whereas in the case of an AIF, he gets reports only on the quarter end, unless you're taking loans at the fund level, in which case he gets monthly reports. But normally he gets reports only at the end of the quarter, which means the fund manager is more free to make investments, and he doesn't have to report to the investor on a daily basis. So it becomes therefore difficult for an investor to copy the strategy of a fund manager, and therefore extrapolate that for his own investment, which is a benefit which many of our fund manager clients have found to be useful in expanding their AUM or the investor base. Moving on to the next slide, I'll briefly mention here about the categories of AIF. So there are three categories: AIF 1, 2, and 3. AIF 1 is basically the earlier venture capital fund regulation. So basically, social sector investing, or more into investing in desirable sectors, and or it could be in special situations like a stressed asset fund, angel fund, or infra fund, etc. These are closed-ended funds, which means the fund have a definite end life. The minimum tenure is 3 years, and generally we have seen funds could be anywhere from 8 years to 12 years in existence. Of course, even if you have a minimum tenure, you can always extend your fund life by approaching SEBI. Category 2 is the residual category. So whatever does not come in 1 and 3 comes in 2. And typically, category 2 is used by private equity funds for making unlisted investments. The statistics later on. Category 3 is basically all your public market investments. So fund managers pooling money for investing in BSE, NSE, or other public markets, and using any complex derivative strategy, etc. Then that investment comes under category 3. Here, there is no minimum tenure. So theoretically, you could have a fund life of even 1 year. You could also be an open-ended fund, which means that you can decide to let's say if you have a monthly closing, then every month you can accept new investors, you can allow for redemption of investors. Typically, we have seen many of our clients, almost say 30 to 50% are open-ended funds, and they might do a monthly or a quarterly closing, which means they allow investors to come in and exit every month or every quarter. And that is the benefit which category 3 gives you, and category 1 and 2 does not give you. So that's the difference between the three of them. Let's move forward and talk about the legal forms of the AIF. So as I was telling you earlier, in terms of the definition, you could either set up as a trust, company, or LLP. Typically, about 70 to 80% of our, or even more, 80 to 90% of our clients set up their AIF as a trust as compared to a company or LLP. There might be a few handful of LLPs, and there are hardly 1 or 2 companies which are set up as an AIF. And the main reason is that from an administrative and operational point of view, it is much more easier to create a trust and to operate a trust as against a company or a LLP, because the company and LLP regulations have not been designed for funds, for redemptions, and for open-ended funds, closed-ended funds. And a trust makes it much more easier. And also, if you have a company or LLP, then the details of investors, etc., are easily available on the ROC website. So there is no confidentiality. Whereas with a trust, there is no requirement for such disclosure. So investor data it can be kept as confidential. Of course, from a tax point of view, LLP and company can be slightly better because the surcharge of 37%, which applies to individuals, does not apply to a company or LLP. It only applies to a trust. So that way, the effective tax rate, and especially if you're doing futures and options, where the rate can become almost like 42%, that can be slightly brought down to 33, 34 if you're a company or LLP. So there have been some instances where our clients have set up two-tier structures. That is category. So that's a trust at the top end and a LLP at the bottom, so that you get try and get the benefit of best of both. Moving to the next slide, in terms of the number of funds, as you can see, there are almost 950 or 951 AIFs which have been set up in India today. Most of them under category 2. These are private investments or fund managers managing private money, both for equity and debt. A large part of FDI investments have also come in through the category 2 route, primarily because there have been certain regulatory advantages for investing through a AIF category 2 as against making investment directly from offshore. There are almost 175 category 3 AIFs. And if you look at statistics in terms of the commitments, then category 3 AIFs have almost about 60,000 crores of capital commitment. And as I was telling earlier, yesterday, almost the AIF total commitment by AIFs is almost about 18% of the mutual fund AUM, which is quite significant considering that it's been about 3 or 4 years, 4 years or so, since the AIF framework has really picked up. And therefore, in the future, I would expect that the total amount of investments happening through AIF will actually increase multifold. Moving to the next slide, let's look at some of the key documentation required for an AIF, and I'll maybe rush through it a little bit. We already at 5:25. So one is your trust deed or the LLP agreement or company incorporation document, which I think is pretty straightforward. The second document is the private placement memorandum. So this is like your prospectus for a listed company. It's a document which details for the benefit of investors various information regarding the background of the fund manager, the investment objectives, the principal terms relating to investment, fees, carry, as well as the investment strategy, tax considerations, etc. SEBI has prescribed a standard template of PPM, and the term and the various items which are mentioned there have to be included in the PPM. PPM is a very important document, not just for investors, but also from a SEBI point of view, and requires very careful drafting. Next is the contribution agreement. It's like a subscription agreement or a shareholder agreement, which is entered into between the AIF and the investors, which contains key clauses and terms and conditions relevant for the investor point of view. And finally, the investment management agreement, which is the agreement entered between the fund and the trustee and the fund manager, which basically lays down the terms and conditions for the fund manager, including his returns and his roles and responsibilities, etc. In terms of some of the key terms of an AIF, which is in the next slide, you will hear things like unit classes, and this is particularly true for a trust structure. So in a trust structure, you could have different classes of units, and this is very very useful and provides a lot of flexibility, because you can create several subclasses within your AIF and within a particular scheme for different requirements and objectives. For example, you want to give a separate return to your employees, and employees can come in with a lesser investment of 25 lakhs in the AIF. You can have a separate scheme, a separate class just for employees. You can have a separate class for your sponsors if you want to give them a different return as compared to the return you give to employees and third-party investors. Even within investors, you could have multiple classes. You could have a class for, let's say, investors bringing 1 crore to 10 crores and 10 crores and above. So you have a lot of flexibility in designing the AIF structure if you want to give different returns to different kinds of investors. Management fee, of course, is pretty straightforward. Setup and operating expenses, these are generally incurred by the fund manager and then charged to the fund, subject to a certain limit of either 0.5 or 1% of the total AUM. And next is the hurdle rate of return. It is also called as the waterfall. This is basically a return which you guarantee to the investors and up to which you will not seek any performance fee, or what is also internationally called as the carry. Typically in the private equity world, 220 used to be the standard term. So for example, the manager will get a 2% fixed return on the AUM and a 20% carry or a 20% share of the total profit out of the 100. But in our experience, we have seen all kinds of different permutations and combinations. To start with the hurdle rate, we have seen anywhere from 7% to 15%, which means if you take 7%, which means if the fund, till the time the fund earns 7% return, it will not take any performance fee or carry. Only if it exceeds that 7%, it will take a share or a part of the remaining profits. That is one. And even how much the fund manager will take as carry or the sponsor will take as carry varies. It could be anywhere from 10% to 20%. For example, if it is 10 and your hurdle rate is, let's say, 7, which means that till the time the fund's return is 7% per year, the sponsor or the manager will not take anything. If it crosses 7, let's say it is a return of 10%, which means there's an extra return of 3%. That 3% is shared between the third-party investors and the sponsor, the manager, in the ratio of 90:10, because that is your carry, which is 10% in my example. There are different combinations to that. For example, you could give different hurdle rates and different carries to investors who bring in different amounts of money. There need not be uniformity in that. And even within that, we have seen different situations. For example, some managers would say that once the hurdle rate is crossed, I will get carry on the entire return. Let's say in that my example, the return is 10% and the hurdle is 7. He will say he will want a share of the entire 10%. In some cases, the manager will say, no, I will take only a pie out of the excess of 3% because that's the extra I'm earning for the investor. So it's quite flexible, and depending on the investment objective and your profile, you can design the hurdle rate and the carry in multiple ways. And then there is catch-up, which is basically is a clause which is used to make the manager whole till the so in the same example as I told you, if the return, let's say your hurdle rate is 7%, and if the fund earns an 8%, then your catch-up will be once you earn that 7, you will get your carry return on the entire 8. So that's basically a catch-up clause which is mentioned. And then the documentation also includes a distribution waterfall in terms of how the sequencing of the returns will be done. Typically, the third-party investor will get his principal back. Then he will get his minimum guaranteed return back, the hurdle return. And then the excess will be shared as per the PPM between the manager or the sponsor and the investors. That's on the basics. I'm sorry, I've taken almost half an hour. Vijay, maybe you'll have to hurry a little bit. But with that, let's move forward and talk about some of the key regulatory aspects of AIF.
Yeah. Hi, everyone. We'll just move on. Sorry. Yeah. Thanks, Rajesh. Hi, everyone. I hope I'm audible. Is it better now? Hello? Hello, Rajesh, can you hear me now?
Yes, Vijay, you're audible. Go ahead.
Okay, perfect. Yeah. So we'll just discuss some of the
key. Can you hear?
Yes,
Rajesh just mentioned he can hear.
Okay, thank you. Sorry.
Okay, thank you. Yeah. So coming back, we will discuss some of the key regulatory aspects of the alternative investment fund. So in case you want to set up an alternative investment fund, a registration is required to be taken from SEBI, and there are some regulations which will be applicable. So the regulations governing AIFs is the SEBI AIF Regulation 2012. These are some of the conditions which are mentioned herein are, so as we discussed earlier, any investor, resident, non-resident, NRI, anybody can invest. Yeah, the AIF needs to have a minimum corpus of 20 crores or 200 million. If you want to have multiple schemes, then each scheme will have to have a AUM or corpus of 20 crores. Yeah. Minimum investment by one single investor is 1 crore. But if the investor is a director or employee of the fund manager, then you can then the minimum investment amount will drop down to 25. And in case the investor is an accredited investor, then the limit doesn't apply. So he can invest even 5 lakh rupees. Accredited investors are basically some high net worth investors who have obtained certification from some agency called as accredited agency. So if your investor has obtained that accreditation, then the investment limit will not be applicable. The maximum in number of investors, as we discussed, is 1,000. Multiple schemes can be launched within the same AIF. So in case you want to pursue different strategies, or you want to have separate rules or separate thing for separate investors, you can create multiple schemes. As I mentioned, that each scheme will have to have a corpus of 20 crores. Co-investment is permissible. So co-investment basically means that if the AIF is investing into some particular entity, and its investor wants to take more share in that particular entity, then he can also directly invest in the portfolio company. So if AIF is investing into, say, HDFC, and investor wants more, then investor can directly invest as well into the HDFC, but the terms should not be more favorable than the terms which are provided to the fund. This is mostly in case of private investments. Yeah. Tenure for a category 1 and category 2 AIF would be minimum 3 years. These category 1 and category 2 AIF have to be mandatorily close-ended, while a category 3 can be open-ended or close-ended. Yeah. Minimum tenure for cat 1 and cat 2 is 3 years. Maximum, of course, there is no limit maximum tenure which is prescribed, but what we have seen is it's about 8 to 12 years, like Rajesh mentioned earlier. In case that 8 years is breached and the fund wants to continue for 2 more years, that is also permissible, subject to obtaining approval from 2/3 of the unit holders by value. The category 3 doesn't have any minimum tenure or maximum tenure or anything. Now, sponsor commitment, I think we discussed. This is the amount paid by the sponsor. For category 1 and category 2 AIF, the sponsor has to invest either INR 50 million or 2.5% of the entire corpus, whichever is lower, right? While a category 3 AIF sponsor will have to invest 5% or 100 million, whichever is lower. Now, this investment cannot be by way of waiver of management fees. So the sponsor will have to actually pay in cash as a part of the sponsor commitment. Yeah. There is a limit in terms of how much one particular AIF can invest in one portfolio company. So in case of category 1 and category 2 AIF, if your suppose corpus is, say, 100 crores, you can invest only 25% into one investee company. So you have to make minimum 4 investments because only 25% can be made in one portfolio company. For category 3, it is 10%. The difference is in category 3, you can also you can use NAV for the purpose of calculating 10%. But in case of cat 1 and cat 2, you have to use your corpus only. Yeah. Leveraging is generally not permissible for category 1 and category 2 AIFs. For category 3 AIFs, it is permissible subject to a maximum limit of 2 times of NAV. So category 3 can obtain leverage by way of loans or by way of investment in derivatives, but the limit is 2 times of the NAV. That is the maximum exposure it can have. Listing is permissible for close-ended AIFs. Open-ended, it's not allowed to be listed because then it will become akin to a mutual fund. Valuation is for Cat 1 and Cat 2, valuation is required once every 6 months. For Cat 3, valuation is required quarterly in case of close-ended category 3, and for open-ended category 3, it has to be on a monthly basis. Custodian is required in case of only category 3 AIFs. For category 1 and category 2, custodian will be required only if the turnover is only if the corpus is exceeding 500 crore rupees. Yeah. These are some basic regulatory considerations which we have to keep in mind while setting up an AIF. Moving on, this is just a quick comparison between a open-ended and a close-ended AIF. So as you can see, open-ended AIF, the investors have the flexibility to commit funds and redeem anytime. Yeah. However, in case of close-ended AIFs, you need to have a final closing. So for example, if the term of the fund is say 6 years, so you need to have a final closing in say 2 years or 3 years. Post that final closing, no new investors can come. But open-ended investors can come anytime and go anytime. Yeah. There is no restrictions on new investors or redeeming the investors. The tenure of open-ended funds is not fixed. It can be ongoing, but the close-ended funds need to have some fixed tenure. 3 years is minimum, and maximum tenure has to be specified in the PPM. Capital commitment, for raising capital commitment from investors, in case of an open-ended AIF, the minimum investment amount which we discussed is 1 crore or 25 lakhs for 1 crore for normal investors and 25 lakhs for employees and directors, has to be brought upfront for open-ended AIFs. But in case of close-ended AIFs, that 1 crore even a 1 crore capital commitment would be enough. So in case, suppose your investor wants to contribute only 25 lakhs upfront, and it wants to contribute the remaining 75 lakhs say after 6 months or 9 months. So what can be done is you can take a capital commitment of 1 crore. So that investor will have to commit that he will contribute 1 crore. And then there is a possibility of drawing that down over multiple years, over a period of time, right? It can be more than 1 year as well. So that is something which is possible in case of close-ended. In terms of taxability, open-ended are a little more risky because the chance of open-ended fund being regarded as an indeterminate trust is higher, right? The other risk is that the trust may be regarded as a revocable trust because the beneficiaries have a right to redeem their shares. But that is irrespective of open-ended or close-ended, because the right of redemption is available in both open and close-ended funds. And with respect to operational aspects, aspects of open-ended fund is it's a little complex for open-ended funds, and for closed-ended funds it's less complex. Yeah. So moving on, if you look at the total timelines, it's about 2 to 3 months. First 3 weeks to set up the fund and create setup of entities and create fund documentation. The next couple of months will be taken by SEBI. Once we file the application with SEBI, there will be a few back and forth with SEBI. Usually there is a few back and forth with SEBI, and post which we generally receive license in about 3 months once you take the decision. And then to start to open bank account and to start all the activities, it will take about 7 to 10 days. So approximately within 3 months, you should be able to, once you decide to set up an AIF, within 3 months, we should be able to operationalize it. Now, quickly looking at the registration process, the first step is obviously to finalize the AIF structure, to decide whether you need to, your manager needs to be a company or LLP or individual, to decide whether your AIF needs to be a trust or a LLP or company. So on and so forth, how is going to be a carry structure and everything. Then the next step is to prepare fund documents like PPM and contribution agreement. Then we have to prepare an application form as well, and everything has to be submitted to the merchant banker. The merchant banker will review the PPM and the application form and issue a due diligence certificate. And that due diligence certificate, along with the application form and all the relevant documents like PPM, will have to be filed with SEBI. Now, SEBI usually has to respond within 21 days from the receipt of the application. In case SEBI suggests any changes, then we have to incorporate that changes into the PPM, and we can consult with the merchant banker or a tax consultant for that. And once that is done, we will get a final certificate of registration. These are just a broad estimate of costs that would be incurred for setting up of AIF. If you see, there are some fixed costs or setup cost. There is application fees of 0.1 million. Then there is registration fees. For Cat 1 it is 0.5. For Cat 2 it is 1 million, and for Cat 3 it is 1.5 million. If you want to just set up a new scheme, then it is 1 lakh rupees or 0.1 million. You can estimate your fees for tax consultants and other service providers for drafting of PPM, drafting of fund documentation, filing of documents and everything to be around 1 to 1.5 million. Yeah. And so this will cover your entire ongoing entire setup cost. And for ongoing cost, excluding those transaction charges, because the transaction charges will be depending upon the transactions undertaken. Excluding transaction charges, it should be somewhere around 1.5 to $2 million, 2 million INR. Sorry. Just moving on to the tax aspects. For there is separate tax regime for Category 1 and Category 2 AIF, and separate tax regime for Category 3 AIF. Looking at Category 1 and 2, Category 1 and 2 are pass-through entities. So AIF usually is not liable to tax on any income which it earns from the investee companies, and the entire income is passed through to the foreign investors or domestic investors, and they have to pay tax as if they have earned that income directly. So whatever income AIF earns, that is taxable directly in the hands of domestic or foreign shareholders. AIF, when the investee company is paying the income to AIF, it is not required to withhold any taxes at source. When AIF is distributing that money to the investors, it will have to withhold tax at 10% for resident investors. And for non-resident investors, it has to deduct at rates in force, which is the applicable tax rate for non-resident investors. The only exception here is in case the AIF has earned business income. In case of business income, pass-through is not available. So if AIF has earned business income, the entire income will be taxable in the hands of AIF itself. Now, there is obviously a lot of discussion in terms of what would be regarded as business income and what would be regarded as capital gains and so on. So before finalizing the entire structure, it also needs to be taken into consideration what is the activity of the AIF, and in case how the same will be characterized, whether as business income or capital gains, and what can be done to achieve that, achieve our desired purposes. There is just one more aspect here. In case AIF has earned capital loss, that also will get passed through to the foreign investors. So in case of loss, that will also be passed through to the investors, whether domestic or foreign. Now, for a Category 3 AIF, it's a little more complex as compared to a Category 1 or Category 2 AIF, because of the fact that there is no specific tax regime provided for a Category 3 AIF. Tax rate would be dependent upon whether the AIF is a company, LLP or trust, because surcharge rate for each company, LLP or trust is separate. Tax rate is also separate. So first of all, the tax rate would be dependent upon the form of entity. There is no pass-through available. Characterization of income becomes a bigger issue here, and we have to see, in case you have set up in case we set up the AIF as a trust, it will depend upon various factors, whether the trust is determinate or indeterminate, whether it is open-ended or closed-ended, whether it is discretionary or non-discretionary. So taking everything into consideration, we will have to discuss how will the taxability of a category 3 AIF will happen. Usually, what we have seen in the market is category 3 AIFs pay tax in their own hands. So the AIF itself would pay the entire amount of taxes due, and the income which it passes on to the investors, it argues that that income is not taxable because that income is already, the tax on that income is already paid by the trust. This is what we generally see in the market, but of course this is subject to discussions and understanding exactly what the facts are, and then deciding in terms of what characterization should be taken. Yeah, I think Rajesh, I think you should take it forward from here.
Yeah, Vijay, one thing I'd like to add, did you talk about classification as business income versus capital gains?
Yeah, I did. I just said that we have to see how the classification will happen. I mean, it's a
Right.
complex issue.
Sure, absolutely. And that's one thing, which has, just to add to what Vijay mentioned, that is one thing which has been a little bit of a concern to some clients, who want to set up an AIF, but then they ask us that, what about the tax risk? Because we don't want a situation tomorrow where the investor exits and the tax liability, any additional liability from the department will fall on us. So we want to be a little careful on that. Obviously there are a couple of little bit of uncertainty on taxation, but generally we have seen clients or AIFs have been able to navigate wherever there are some positions where there is an uncertainty. You can always create a provision and keep that much of reserve in the fund so that the manager doesn't end up paying any additional taxes. And mainly this relates to classification. For example, if the fund is doing a lot of short-term trading, then the question is, will the benefit of the 15% capital gains tax rate be available, or whether the entire income will be taxed at 30% as business income? So that is one wrinkle or area where there's been a little bit of uncertainty. So with that, I don't think we have a lot of time. We have a few slides on Gift City. I don't want to take through the entire. Vijay, maybe you can go to the first slide. I don't want to take through all the slides in detail, but all I want to mention, maybe just to give a little bit of a flavor, and then I'll talk a little bit for 1 or 2 minutes on the IFSC fund, is that there are a set of people who have been very excited about the Gift City. There are a set of people who are a little still skeptical, saying that will the Gift City framework remain? What if the government changes after 2 years? Will the benefits continue? Who would are we required to move our entire team to Gujarat or Ahmedabad? Can we just have a skeleton presence there? So certainly there have been few concerns about the Gift City, but I can tell you that as time is progressing, the amount of investment which is going into the Gift City is slowly and gradually becoming quite prominent for any government to suddenly take away the benefits of the Gift City. So to my mind, as I'm seeing it currently, Gift City is certainly here to stay. Of course, relocating to Gandhinagar is a little bit of a concern, and we have seen it is, you can easily get finance and accounting professionals in Gujarat. Gujaratis are very well versed on that, and especially with COVID, there has been no need to have full-time presence over there. And even in future, I think in the next foreseeable future, the idea is to either work from home on a hybrid model. So I think certainly you can work out things, and especially in these new regulations, what you can see on the screen, the IFSCA authority, which is the authority controlling Gift City entities, has quite diluted the requirement for substance in the Gift City by saying that the business origination or the origination of trade should happen from the Gift City, but the trade execution and all the other functions relating to investment need not be in the Gift City. I mean, while they have not, in as many words, said it need not be in the Gift City, but in the draft regulations, they had written that trade execution and support and everything should be in the Gift City, which in the final regulations they have removed. So by inference, you can do many activities, continue to do them from Bombay, Delhi, Bangalore, and have fewer activities in the FSC. You can always structure that well so that your tax benefits are protected, and commercially you try and do as less disturbance as possible. Now the question is, and just to add, I've also seen about 15, 20 or more AIFs in the GIFT City, a lot number of AIF3s. There have been a few AIF2s, a couple of foreign clients. In fact, currently I'm speaking to one of the largest asset managers stroke investment banks in the world who are setting up a AIF2 and AIF3. They're going to set up in the GIFT City. There are a couple of very large domestic fund managers, very, very large, who are setting up presence in GIFT City. So it is definitely gaining importance. Now the question is, why GIFT City? GIFT City can work in two situations. One is if you have foreign investors who want to invest in the Indian market, or if you want Indian investors and want them to invest offshore. GIFT City cannot work if you are looking at Indian investors and you want to bring them back and invest in the Indian market, because as per the regulators, that is round tripping and that is not allowed. RBI under LRS route or liberalized remittance route, which is used for overseas remittances, does not allow LRS money to be used for putting in the GIFT City and then reinvesting back to India. So which means that if you are looking at setting up a fund offshore in any of the foreign countries to attract foreign money, then GIFT City provides a very good alternative to that, both from a regulatory perspective and from a tax perspective. And Vijay, if you can go to that slide on the comparison with the offshore jurisdiction. So for example, if you are in the GIFT City, then there is no tax on any kind of income except share income. So let's say you set up a fund in the GIFT City, then any capital gains on non-equity investments, for example, futures and option trading you do on BSE, you invest in GIFT securities, you invest in foreign securities, all of that is fully exempt from tax. And your dividend income is also taxed at a lower rate of 10% as compared to higher rate in the treaty, or domestic law also provides 20 or 40 for interest and for dividends and interest respectively. Then as far as the manager is concerned, your management fees will be completely exempt from tax. There will be no GST. There is a 9% MAT in the GIFT City, but if the manager is set up as a company and opts for the lower rate of tax, which is 22% in the new regime, then there is no MAT also. So full exemption from income tax, GST, from stamp duty. I have a couple of high frequency trader clients for whom stamp duty is very significant, and they are setting up a presence in the GIFT City to avoid the stamp duty, because the Gujarat state government does provide that. And then you don't have to be worried about any concerns about anti-avoidance rule, which if you want treaty benefits, then that becomes a problem. And then now there's an exemption for the investor. So if you have an investor coming in the GIFT City fund, then the investor doesn't have to get a PAN or file a return, which if you set up an AIF in the domestic area, then the investor has to get a PAN or file a return. So many advantages are there. Definitely the framework is very good. And in this new regulation, which we had a lot of slides, but we could not cover, and we will circulate the slides, so you'll get all of that in detail. But in the new regulation, what they've now done is try to bring in some international principles. So now they will regulate the fund manager instead of the fund. And once they regulate the fund manager entity, then the manager can then set up different kinds of investment vehicles or schemes or funds. So every scheme or every fund you set up does not have to be regulated or licensed by the IFSC or the GIFT City authority. This is a complete change from the domestic regulation, where every time you set up a fund or a scheme, the fund has to take approval. Whereas in the GIFT City, the manager gets a license and not the fund. This is as per international practices. So that's about the GIFT City. I will not spend more time on that. I'm aware, all of you would be busy, and so we will leave the slides with you. I want to stick to the time. I will take 1 or 2 minutes, as I mentioned in the beginning, just to let you know how we can help. So we provide, Deloitte provides the entire end-to-end services, both from a setup perspective and on an ongoing perspective, without the need for any other service provider support as far as professional services are concerned. So as you can see from the slide, starting from discussion on your fund structure, how you should set up your sponsor, manager, the carry structure, and other key aspects in relation to investor rights and different classes of units to investors, etc. We provide advice on that, help you structure the entire documentation, and then based on your commercial objective and all of these different items, we will draft the PPM or the private placement memorandum. We will draft the trust deed, we will draft the investment management agreement, or support you in all of this contribution agreement, carry document, and then we will help you in terms of setting up the entities. So whether it is the trust deed or a company or a partnership or LLP, we help in set up, following up with the regulators and getting you approval on that. Then we will also work with SEBI, prepare the draft application for AIF, and work with SEBI to get the license. So in other words, entire end-to-end setup from a professional services point of view. Vijay, next slide, please. And then again, on an ongoing basis, we provide full support and if you don't want to insource anything in your own team, we provide full support, or we could provide partial support as per requirement. So for example, TDS requirements, advanced tax return, FATCA CRS, redemption, so providing letters to investors and computing taxes on redemptions, providing various reports to SEBI and RBI as required from time to time, giving statements to investors on distribution, as well as helping in the calculation of taxes for NAV. Because when we do our FPI business, we have a very sophisticated in-house or inbuilt software, which helps in calculating capital gains and capital gains taxes, and also used to calculate tax accrual or tax on shares which are not sold for the purpose of NAV calculation. So we work with different custodians and fund accountants in providing that support as well to you. So complete end-to-end, both on the setup and on an ongoing basis. So yeah, that is the end of our presentation. Thank you. There are a couple of questions which are unanswered. I've tried to answer most we can. Just quickly see, there's one question on, can you clarify on the business income in AIF? So maybe just for everybody's benefit, and I think this is important. So unlike an FPI, where the income is very clearly capital gains and the law provides for that, in the case of AIF, there is no clarity in law. So the income can either be business income or it can be capital gains, just like an individual investor. Today, if you and I invest, there is no certainty how the income would be treated, and it depends on various factors. Like, do I have a side business? Do I use loan money for investing? What is the frequency of trading, etc. Similarly, for AIF, it can depend on multiple factors. Now, that's a little bit of uncertainty, and maybe that's why a largest part of AIFs have been set up for as long only funds, rather than doing short-term trading, etc. If you do derivative, then you're taxed at 30% in any case, so it doesn't make a difference. But generally, managers who do a lot of short-term trading have kind of tried to stay away from AIFs. If you do long short, you're fine, etc. But then one way to overcome also is to have two separate investment profiles. So wherever there's a risk of business income, you treat that separately with a separate demat account, etc. And wherever the strategy is long term, you treat that as investments. So there is no need to treat all of your asset classes or all of your trading as business income, etc. So there are a few ways to overcome this issue. And as I said, it depends on the facts, and we are certainly happy to support in designing this. What is the aspect for trustee or sponsor to set up the AIF? What is the eligibility? We have mentioned that in the slides. we will highlight that once again. I will talk to Aditya and see how best we can get the email addresses of all of you, that whatever questions are remaining, we can answer them on email. With that, and yes, I'll share my contact details and the contact details of my team, and look forward to working with you all, helping you all to navigate. If you have any questions, please feel to reach out to us. It is not necessary that you should be looking at setting up a fund. Even if you're not looking at setting up a fund, but you still want to understand more, then please feel to reach out. We'll be happy to support you. With that, thank you to all of you from my team here, and have a good evening. Thank you.